Hey guys, Chris from Adapt Tuition here, and in this video, I'm going to show you the solution for question 1 from the Jan 2008 PoA Paper 2. If you want to see the solutions to the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the question. Okay, so they start us off by saying that Johnson Company prepares the following list of account balances as at 30th September 2007. Okay, so they give us a nice long list here, and we can see some of the usual stuff. Sales, transportation in, also known as carriage in, interest revenue, okay, loan, that's a liability, sales returns or returns inwards, purchases returns or returns outwards, opening stock, purchases, salaries expense, insurance expense, buildings, provision for depreciation on the buildings, debtors or accounts receivable, creditors or accounts payable. Provision for bad debts. Watch out for that one. Bank, cash, capital, and drawings. Okay, now we have the usual additional information. 6 items, let's go one by one. First item up, closing stock at year-end, $14,800. Whoops, right? Second item up, the insurance expenses for the 2 years ending September 30th, 08. So the list of balances above was at September 30th, 07. We paid the insurance for 2 years up to September 30th, 08, which means to find the expense for insurance for this year, we have to divide by 2. If we paid, let's say it was 1,000, actually no, how much was it? It was 6,300, look at here, right? So 6,300 covers 2 years. So to find for 1 year, we'll just divide by 2. All right, sorry, next, item 3. 1,200 in interest revenue remains to be collected. That means it's outstanding or accrued. That's accrued revenue. And we know what we do with accrued portions of items. We add them on to find the income statement figure. Next, 4. Johnson owes workers 3,200 in salaries. So that's an accrued expense, which again we'll add to the salaries figure in the list of balances above to get the income statement figure. Next, buildings are depreciated at the rate of 10% per year using the straight line method. Okay, straight line method, you're just going to multiply that 10% by the cost. And finally, provision for bad debts is to be decreased to 500. So when we have a decrease in the provision for bad debts, we have to add the amount of the decrease to gross profit before we deduct expenses. So it's treated like a revenue. Okay. Now I'll tell you one time. What they want us to do is an income statement for 12 marks and a balance sheet or a statement of financial position for 8 marks. So I'm going to pull up my income statement format here. So of course, don't forget to head up. Johnson Company income statement, FYE is for the year ended 30th September 2007. So as we know, the first item to go inside of an income statement usually is the sales or the revenue figure, which in this case is 87,400. So we're just going to populate that very quickly here. Okay, now, do we have returns in? Yes, we do, but they call it sales returns. So that's 4,250, which we're going to subtract from the sales revenue to get net sales of 83,150. From that, we have to minus our cost of sales or cost of goods sold. The first item in cost of sales or cost of goods sold is usually opening stock, unless you don't have it. Okay, now to that, we have to add purchases. Where was that purchases figure? Actually, right below the opening stock, 30,900. Very good. Now, we have some adjustments to make the purchase. The first one is the transportation in or carriage inwards. That forms part of the purchase cost of the goods. We're going to add that, get a little subtotal. And of course, don't forget, just like how we have sales returns, we have purchases returns, which has to be deducted because we sent those back. So we no longer have those goods, so we can't count their cost as part of the current cost structure. So the net purchases is 25,004, which will be added to the 89 of opening stock to get your cost of goods available for sale of 44,300. The final item is the closing stock, which was given down in the additional information section, 14,800. We're going to subtract that and get our cost of goods sold of 29,500. We're going to subtract that from the net sales of 83,150 to get our gross profit of 53,650. And now we have a couple of revenue items. First item up is the interest. So up in the list of balances, we had interest revenue 2,300, but always remember to check your additional information section. Item 3 in the additional information section says 1,200 in interest revenue remains to be collected. That means it's accrued, and we have to add that accrued portion of 1,200 to the 2,300 from above, as you can see in this working here, to get the interest revenue earned of 3,500. Now, the next item was the decrease in the provision for bad debts. So, item 6 says the provision for bad debts is to be decreased to 500. So, currently, the provision for bad debts in the list of balances is 700. So, to go down from 700 to 500, that's a decrease of 200. And the that decreases the amount that goes in the income statement. And you can see again a little work in here. 700 minus 500 is 200. So 3,500 plus 200 is 3,700, which we'll add to the 53,650 to get our profit before we subtract expenses. Now, expense-wise, we had a salaries expense. Now, I believe there was an adjustment. Item 4. Johnson owes workers 3,200 in salaries. So just like we added the interest revenue accrued above in the revenue section, we're going to add the accrued portion of the salaries here. So 23,800 from the list of balances plus the 3,200, right, is 27,000. Okay, the next item up is insurance expense. So we talked about that earlier. It's 6,300 here in the list of balances, and item 2 says that the insurance expense is for 2 years ending September 30th, 08. So 6,300 was for 2 years. So to find for 1 year, we'll divide by 2, which will simply give us 3,150. Now, the last item of expenditure was the depreciation. So note 5 tells us buildings are depreciated at the rate of 10% per year using the straight line method. So we simply multiply that depreciation rate 10% by the cost of the buildings of 100,000, and that's going to give us $10,000. We add all 3 expense items together to get total expenses of 40,150, which is then subtracted from the 57,350 to give us a net profit or net income of 17,200. Okay, that's it for part A. Let's take a look at part B. Okay, so we have a balance sheet or statement of financial position to do. I'm going to do it in 2 ways. Both of these ways will be in order of permanence, starting with your non-current assets, then going to current assets. The way I like to do it is the net asset approach. So total assets minus total liabilities on top equal to capital below. But I'm also going to show the assets equal to capital plus liabilities way, which is actually the way CSEC likes you to show it. Now, if you show it in the way I show it first, which is assets minus liabilities, that's not wrong. Unless the question specifically requests a particular presentation of the statement of financial position, you are free to use whichever one you choose to use. Okay? Now, let's of course head up our financial statement. Name of the entity, name of the statement, and the period to which it applies. So we're dealing with the non-current assets first. Now, we only had one non-current asset, which was the buildings of 100,000, and we had the provision for depreciation given as 35. But don't forget, the last expense we calculated in the income statement we just did was the current year's provision for depreciation on the building of 10,000. We have to add that 10,000 to this 35 to get the total, the new balance for depreciation going forward. So that's going to give us 45,000. So 100,000 minus 45,000 is 55,000. Next, we're going to deal with the current assets. So the first item will be the stock, the inventory, the closing stock of 14,800. Then we have the debtors or accounts receivable. So this was an older paper, so they were using some of the older terminology. So debtors is 8,700. Now don't forget, even though you put in the 8,700, there was the provision, note 6. The provision had to be decreased to 500. So we have to subtract the provision for bad debts from the debtors figure to give us net debtors or net receivables of 8,200. The next item up would be the prepaid expenditure. So you might be asking, well, Chris, what prepaid expenditure? That's note 2. Remember, the insurance expense was prepaid. It was paid for 2 years. So we still have a next half of 3,150 already paid for the next financial year. So we're going to put prepaid expenses there. And the item right below that was the accrued revenue, the accrued interest revenue, which is 1,200. So we're going to add that there as well. Now, the only other 2 items of current assets were the bank and cash of 12,450 and 900. So we're going to plug those in. And then we're going to add those items to get total current assets of 40,700, which we'll add to non-current assets to get total assets of 95,700. Now, I like to subtract my liabilities. So we're going to start with the non-current liabilities. Now, there was a loan They didn't tell us if it was a current or non-current loan, but generally speaking, we could safely assume loans are non-current in nature. So we're going to put that item there and put the subtotal for that section. There's only one item, so you can really have just put the 23 in the middle and not bother to list it. But in case you ever encounter a question with multiple non-current liabilities, you're going to want to list them out and then put a subtotal to the right. So now current liabilities. Okay, so I know we had creditors here, and we also had Johnson owes workers $3,200 in salaries. Okay, so we're going to put those items in, right? So creditors $4,300, accrued expenses $3,200, only two. We add them together, get $7,500. Add that to the 23 and get $30,005. That total for liabilities is now subtracted from the 95.7, which is total assets, to get net assets. Sorry, net assets minus liabilities of $65,200. Now, of course, the assets are the resources of the business, the items that we use in order to operate our, as you can see, the buildings, the equipment, whatever it is, right? Where do those resources come from? Or where does the money to buy those resources come from? It comes from the owner or from entities other than the owner. The owner provides capital, the other entities provide liabilities. So we've already catered for the liabilities. We know how much of the assets are financed by liabilities. The remainder of the assets have to be financed by capital. So we're seeing that here, financed by capital. Now, the opening balance of capital was $60,000. So we're going to put that here. To that, we have to add the net profit that we calculated in the income statement above of $17,002, was it? Yes, it was. We're going to add that to net profit, to opening capital, because remember, why do people start business? To earn a profit. What does profit do? It increases the owner's investment. It increases capital. So that's why we add it. And we, of course, have to subtract drawings, because drawings represents the withdrawals of the owner from the business, and hence will decrease capital. And when we subtract that 12,000 from the 77.2, guess what? We get 65,002, which matches with the net assets minus liabilities, which we found a bit earlier, and your balance sheet balances, right? So that's what's supposed to happen. Now, as promised, I'm going to do this balance sheet, but in a slightly different format, shifting the liabilities down and adding them to the capital figure to show a slightly different presentation. So give me one quick second. Let me put this item on the left-hand side and put the fresh balance sheet on the right-hand side. Okay, so I'm not going to go through the balance sheet again as I just did. I'm just going to populate the items so you can see and compare how these two different statements look. Well, they're not different. They are the same. They just have a slight difference in presentation. So again, in order of permanence, we're starting off with the non-current assets. We had one. Then we had current assets. So we had stock, debtors minus the provision, giving us net debtors. We had the prepaid expenses and accrued revenue, bank and cash, giving us total current assets of 47, which when added to 55 gives total assets of 95.7. Now, we're stopping the top half here. And these assets, like I said, assets are the resources of the business. How do we pay for them? How do we finance the purchase of these resources? Well, the money for that comes from the owner and from creditors. The owner provides capital, creditors provide liabilities. So that's why it says, financed by capital and liabilities. The assets are financed by or paid for by capital and liabilities. So the capital section will just look the same. I shifted it across to the left middle column because I like to put more workings there and then put the totals to the right. But you don't have to. You could put this batch of working in the rightmost column. Doesn't really matter, to be honest. Okay, now the non-current liabilities go next. Now capital is more permanent than liabilities because the owner's investment kind of stays in permanently, right? They usually don't take it back out. They get earnings via net profit, but their initial investment usually stays in. Right? But of course, yes, they are repaid via net profit. Okay, so we had one non-current liability, the loan, and then we had two current liabilities, the creditors and accrued expenses. When we total those, we get 35, and when we add that to the 65.2, guess what we get? Total capital and liabilities of 95.7, which matches with total assets of 95.7. And again, your balance sheet balances. So, like I mentioned just before we started this, I was doing this two different ways. But it's the same information. We just rearrange a little presentation. We rearrange the sections or the classifications to have a slightly different presentation. But they both communicate the same information and both follow the order of permanence. All right. Anyhow, that's about it for this question. Okay, guys, so there you have it. That's the solution for question 1 from the Jan 2008 POA Paper 2. If you have any further questions about it, please feel free to leave them in the comment section below and I'll get back to you when I have a chance. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe and be sure to check out my website where you'll find some pretty useful POA handouts. Anyway, guys, as per usual, thank you so much for watching. Take care of yourselves and I'll see you next time. Bye.